Well, hello, Adam Gower here at GowerCrowd, and these are turbulent times. It's not often that I do podcasts that are not evergreen. I do prefer to have podcasts that remain evergreen, that can be listened to as relevant at all times. But with the crazy things going on in the market right now, my opening question to Brian today, my guest, Brian Adams, founder at Excelsior Capital, does speak to the events that are surrounding us. So you will be fascinated to learn what his insights are about what's going on. Brian has an interesting platform. He is running a family office and they invite individual investors to join them in some of their deals, but he also promotes other people's deals, not just real estate. To find out more about Brian and his company, go to the podcast page at GowerCrowd.com. And while you're there, make sure to click on the news link at the top of the menu at the top of that page and sign up for our weekly newsletter. We distribute information about the real estate syndication industry, crowdfunding industry that is as comprehensive as you will find anywhere on the web. It's totally free and it goes out every Wednesday. So be sure to subscribe there, all at GowerCrowd.com. Now, before I introduce you to Brian, I will say that it is definitely worth inviting him to your podcast because you get a super cool piece of swag from him, some Excelsior Capital swag. I got a really excellent coffee cup. Thank you so much for that. We're just in the final throes of putting together our own loyalty-based swag package. So it was nice to see something from Brian. It is rare that I get anything in a very nice touch. So thank you, Brian, for that. And for you now listening in today, here he is, Brian Adams, founder of Excelsior Capital. Brian, oh my goodness, it's been a long time coming. Thank you so much for your patience before coming on this podcast. It's great to see. I'm going to open with the only thing it has to be on everybody's mind. Are we in a Wile E. Coyote moment? Inflation, rising interest rates, sanctions, war in Europe. Has the bottom fallen out? What the heck's going on with commercial real estate?
Yeah. So it's interesting. I talked to my father about this recently, and history's good perspective here, obviously. If you look at the post-World War II era, call it that 5 to 10 years, where you had a lot going on. And then you also look at maybe the late 60s, where you had a lot of these type of geopolitical, domestic, civil, as well as financial dynamics all coming together in a confluence of events. And I learned, interestingly, that a definition of confluence means that there are two streams of the same level of energy, right? So it can't be differentiated there. These things all do seem to be a confluence today. I feel very confident that there'll be a good outcome here across the board, given time. But when you're in the doldrums, it can feel like everything's going sideways. And real estate has proved to be a very resilient asset class as long as you have a long-term time horizon.
Exactly. You've got to have a long-term time horizon. So you mentioned your father. Is he an historian or something, or just because you chat with him about these kinds of things?
He is a retired attorney that's now become my therapist. As I, hit my late 30s and have children who are growing older and have a business owner, he's been an entrepreneur his whole life as well. I come to him with all of my problems, and he's kind of like my high-priced plumber that I try to come to him and I say, help me fix this. And he kind of calms me down and tells me that, when, JFK was assassinated, Bobby Kennedy, MLK, there were riots in the streets, cities burning, inflation was out of control. The Soviet Union was a real threat to global peace and stability. It just helps me understand that we're never living in normal times. I think this is just a journalistic cliche that gets tossed around a lot. this is the world, right? This has always been the world. I think now with the media and our consumption of media and how it's changed, we're just hyper aware of all these horrible things happening, but they've always been out there in that space.
Well, they have, but world economies are significantly more intertwined than they have been at any point in history. And anything that happens on the scale just the sanctions alone are so massive. And the disruption to fuel supplies and food supplies, and you don't. By the way, you're not the only person I'm asking this.
Yeah, no,
you don't sense that there's a huge wave headed our way, or that the ground has actually fallen out beneath us, but we're still running along in a Wile E. Coyote confident manner.
I think one of the issues that doesn't get spoken to often enough in today's kind of above the fold news is the fact that, the U.S. is now a net exporter of energy, right? And that's been a huge shift since the 70s. If this were the 70s or the 80s and we were really dependent on international energy sources, I would be very concerned. But we're really solidified from that standpoint. We're not dependent on some of these other countries. Now we are trying to make inroads with Venezuela and some of these other bad actors to be a backstop. Russia's GDP is about equivalent to the state of Texas. And if it weren't for the energy sector, they don't really have a dynamic economy. There's a reason that we came up with the term first world, second world, and third world, right? The Soviet Union and the former Soviet Union states, including Russia, are considered second world economies. And if it wasn't for their part in World War II and the establishment of the UN, et cetera, they wouldn't be on the Security Council. So I think, honestly, they've really overplayed their hand here. They've driven unification within the EU, within NATO, and they've really kind of created an axis where it's Russia, China versus the world. And I think today's global marketplace, considering that China really needs to keep its burgeoning middle class stable and happy, this type of unrest globally is not in China's favor. And so if Russia's going to come to them looking for an out economically or militarily, China's going to require that they get things back to baseline. So, it's horrible to see all these things happening, but I think we're going to be okay here.
Right. So think globally, act locally. You're in Tennessee. I must say I'm very disappointed that you don't have a Southern accent, because it's one of the prettiest accents in the union.
We can get my wife on here. She's a Nashville native and has a legit Tennessee accent. I'm from New York originally. My father would say he spent a lot of money for me to speak like this growing up with education. But I've not adopted the twang yet.
The local dialect.
Only when I drink tequila. Yeah.
And then it comes. Is that tequila now? It's a big glass of tequila you got there.
No. I don't start drinking until well after lunch. So.
Right. So what's going on in Tennessee? Tell me what's going on. You're multifamily guys, right? So what's going on what are you seeing in Tennessee?
Yeah, we only do commercial, so we actually don't do multifamily or any. It's okay.
Of course, I've got your website up here.
You do a lot of these.
One page that I want to talk about, so
sure,
like on that page and nothing else. Just tell me.
No worries.
What do you focus on? What you're seeing in Tennessee?
Yeah, I mean, we're solving for yield, right? So we work with accredited non-institutional investors. So initially started the company to help a problem that our family office had, which was accessing good quality direct co-investments that were targeting double-digit yields on a deal-by-deal basis, but that didn't have LPs that were non-taxable, right? So what we found was often a lot of the sponsors or fund managers we were working with had big endowments or institutional non-taxable LPs that were really driving the investment decision-making process in a tax inefficient manner for the other equity holders that were taxable entities. So we created this platform for initially the family, and then it became friends and family. And now we have a really broad network of investors, but we still try to solve for those three pain points. And we still try to work with just that discrete population set. So right now, frankly, in Nashville, my cost of capital, in other words, my yield that I'm trying to achieve to my investors that we send out in monthly distributions, is not possible to achieve today in Nashville. It's become an institutional marketplace. Cap rates are ridiculous. I think it makes a ton of sense to develop in today's market here locally. But if you're trying to buy core plus, value add, forget core, you're going to be paying a very high price point. And as my mentor has told me over the years, the three most important words in commercial real estate investing are basis, basis, and basis. And so when you go in with that price per pound, you're married to it for the rest of your investment horizon. And it's just not something that we can accomplish given our investment strategy.
Brian, it's an interesting perspective that you shared on the institutional partners that you had. I haven't heard that before, and I've heard a lot. That one of the reasons for their cost of capital being so low, I'll try and connect the dots to what you just said. Their cost of capital being so low, and therefore their ability to pay up for assets, or making an assumption, is because their capital is non-taxable. Is that right? That they are when they're underwriting to the bottom line, they're underwriting in a different way because of taxes than individual investors or other private equity sources might have. Can you just elaborate on that a little? It's an interesting observation.
Sure. I think that's part of the equation, right? Is if you're not a taxable entity, then tax efficiency or after tax returns, net of fees, only part of that equation relates to, right? So for instance, I get asked a lot, like what the definition of a family office is. And so for me, it's a corpus of assets meant to maintain a quality of life across a multiple generation time horizon. Now, when you think about kind of high net worth individuals or families, and you talk about asset allocation or return profile or expectations, it's really simple math, right? You've got inflation, and let's call it 3%, even though we've been seeing 7 kind of, and we can talk about inflation if you want, but let's peg it at 3%. And then you've got your spend rate, or maintaining your quality of life. Let's call that a 4% overhead spend rate, plus the exponential growth of your family. You put that all together, you probably need to be hitting annual 10% plus returns to maintain that quality of life over multiple time horizon generations. But importantly, when you're making these investment decisions as a family, you're looking at net of fees after tax returns, right? Because taxes and inflation will kill you over the long term when you're dealing with a kind of corpus of assets that the principal is not going to change dramatically. Whereas if you are an institutional investor and you're non-taxable and you're trying to solve for a 3 or 4% return, that's a different mindset, right? And that's a different investment strategy and thesis. And that's what we've been seeing play out over this last, call it since the Great Recession, this search for yield, this liquidity in the marketplace. At first, it was driving institutional investors, especially international, to come to domestic US, which then meant the private equity groups had to go lower. And then it's now trickling all the way down to fundless sponsors like myself.
So you chose to expand your investor base and look at private individuals or individual investors, individual high net worth accredited investors, and build, want of a better term, build a crowdfunding platform over there at excelsiorgp.com. Tell me about that process. First of all, why did you choose to do it that way? If your family office, you've probably got some good personal connections. Your father's an attorney, probably got a decent database. So just explain the logic behind why you did that in the first place. And actually how you got started. What was the first thing you did?
Yeah. So like I mentioned, I'm from New York originally. I met my wife in college in New England, and she's from Nashville, right? So we did the New England thing for a little bit. We both went to grad school in Boston, moved back to Nashville 15 years ago now. And like I mentioned, my wife's family has a single family office. I had no idea what that was, or really what private equity was when I joined the family. But during the course of the prenup negotiations and then onboarding as an ex officio member of the board, I got exposure to all these things. I started learning about GP LPs, funds, private equity, commercial real estate, et cetera. And, wasn't entirely enamored of being an attorney for the rest of my life. And so started exploring real estate, thought it was a great asset class, a great business, and very clearly saw a problem in the marketplace, kind of what I referred to earlier, where individuals and families, when they wanted exposure to commercial real estate, they had to go through a big fund with a really high minimum, or even a fund of funds where you're paying 2 or 3 levels of fees and you have no relationship with the GP, or you had a one-off deal from your country club friend that, wasn't professionally managed. Or, you could go to the REIT market, which I think is a really suboptimal proxy for direct real estate investing on a number of levels. And so there wasn't really good optionality. Crowdfunding was just starting to come onto the scene. But I saw flaws in the systems, right? Deal flow quality was hit or miss sometimes. There was certainly a friction cost involved in that, where that cost of capital that the sponsors and GPs were going to pay to, have access to that database of investors was really going to flow through to the LPs themselves in terms of how they were going to capitalize that cost. And so I thought there must be a better way to do this. I built up about a $250 million portfolio, recapitalized that. I made a bunch of mistakes the first time around. And I launched Excelsior 4 years ago, to try not to repeat those mistakes, to really streamline it, and to create a better investor experience across the board. And so
Brian,
the answer,
when did you start actually?
2010.
2010.
Yeah.
All right, go on. So that could just about to answer my question.
Long-winded answer to your question, but in my world, after we did that recapitalization, we had a decent sized portfolio. We had raised 3 funds in order to build that portfolio successively. Most folks in my world, and we looked around at this for a while, would say, okay, I'm going to raise a $250 million blind pool commingled fund with institutional LPs. I'm going to get an anchor LP that's going to do 25 million. And then we're going to try to get, a bunch of 5s and 1s, et cetera. Well, that's pretty much every sponsor's plan and what they want to do. And it's a very competitive marketplace from a fee, from a control, from a legal perspective. And that universe of LPs is fairly discrete, right? It's a concrete list of, call it 1,000 pension plans and endowments and insurance companies, et cetera. And they're not really making any more of them, right? Maybe some large family offices are coming online. Maybe there's some larger groups, but for the most part, they're not making new endowments or pension plans. And those LPs know it, right? So they exert a ton of pressure on GPs who are kind of emerging like I was. The other side of the equation, the crowdfunding, there was a lot of opportunity for people to work with unaccredited investors in many different ways. But we started reflecting and talking to GPs and sponsors, and we realized, okay, well, the one population that a lot of sponsors don't want to work with are the ultra high net worth individuals and families. It's a fairly long sales cycle. They're very high touch clients, but they're still only going to do 50,000, 100,000, maybe more, but we're not talking huge check sizes. Doing it on a deal by deal basis is very challenging. You need to have a bunch of infrastructure because your conversion rates are going to be what they are, right? We know what the ratios are. We've talked about this. And that the number that people don't want to raise is typically between 3 to 5 million of equity. It's considered a very challenging space, right? It's below what a big group will write, but that's a lot of $100,000 checks. And so we decided, well, that's exactly where we're going to spend all of our time and all of our focus, because we think it's the most inefficient part of the market, both from a deal flow perspective and also from an investor perspective.
So getting started on this path to meeting total strangers and encouraging them to part with $100,000 minimum, what were the biggest hurdles once you got started?
When I first got started, so biggest challenge obviously is just getting the at-bats, right? I mean, if your conversion rate's going to be 3 to 5% for people.
So say that again, getting the what?
At-bats, like the reps, like the pitch.
At-bats.
Sorry, the Americanisms of a baseball metaphor, but
an at-bat.
Yeah, like a try, like a practice just getting the coffee meetings and the dinners and the lunches and the calls, getting them scheduled, getting the pitches in. So I used to, an old sales mentor of mine, I learned a trick from him when I first started out. I was not allowed to close down for work for the week unless I had 3 meetings and 5 phone calls set up for every day the following week. And even if it was like my dad and my brother, like I had to have something on the books. And so I used to try to do, at first it was 3 and 5, and then I went to 5 and 10. I tried to have 5 meetings a day and 10 phone calls a day. And I did that for...
Just mind blowing, isn't it? I mean, when you describe that, that is exactly the opposite of the world I try to create.
Yeah.
Minimal calls, minimal meetings.
Yeah.
How can I avoid everything and do it all online and automated? Anyway.
Yeah, right. So, and we've kind of obviously pivoted, but that was the original business model, right? Was this is what I was going to do every day. And I did that for a couple of years, in addition to travel and conferences and that kind of thing. That's how I first got into the business.
Yeah, it's a lot of brain damage, isn't it? So, right. So you started crowdfunding. You built a nice platform over there. You've done a nice job of it. And you've moved to marketing, right? So now you've created your mousetrap, for want of a better term, and you start marketing. So what are the most effective marketing methods you have now, right? In the past, it would be 3 meetings a day and 10 phone calls. What works well today for you?
Yeah. And one comment to your statement about the brain damage, and it is a lot of work. It's not supposed to be easy. And I think people in who aspire to be a GP or a sponsor, they want to avoid that sales part of it, right? They want to be able to just circumvent it. But there's a lot of lessons to be learned there, right? In terms of getting the meeting, having the meeting, doing the pitches, getting the feedback, going to Tulsa for that lunch meeting that you just never know what's going to happen there. I mean, that's kind of how I came up in the business. So I would embrace it if I were people, but there certainly is a better mousetrap out there. And so from a marketing perspective, I think the best thing that we've done is oftentimes sponsors, and this was certainly the case for me early on, when I meet a prospect or I have a current LP and we're going to have a conversation, it's going to be a transactional binary conversation. I'm going to offer you a widget and I'm going to ask you for your time and money in return for that widget. And you're going to say yes or no. Now, the way that we've created things from a content perspective is we give people educational content, we give them access to resources, and we give them a community of like-minded investors, peers, and affinity network. These are all things that what I call can allow them to be in the neutral zone or the parking lot. So once they enter into our ecosystem, they can spend time at these places through LinkedIn, through co-branded content, through my podcast, through some of the webinars that we do and some of the networking events that we do. These are all places where I'm not asking them for anything. I'm just giving them things, giving them resources, giving them connections, giving them access. And over time, it's going to become, okay, well, I've gotten to know Brian. He's been really helpful to me. Let's now initiate this next level of the conversation. So it's really taken away this very transactional binary type dynamic and created more of a what I would call like a lead nurturing type of space where people can get comfortable, get to know you, and then it turns into a logical conversation of, okay, well, let's talk about investing.
Yeah, I mean, that's what's interesting, isn't it, Brian, about moving your efforts online from the in-person world. Your time is levered. Before, you can only engage with one person at a time, one phone call, one meeting. That's why, what was it? What did your mentor say? 3 meetings, 10 calls. So figure 5, that's 8 hours a day, solid, just one-on-one. Whereas now you put a podcast out and, in my case, at least 3 or 4 people hear it all at once. It's like,
yeah,
I'm just joking. But, so basically you leverage your time. You still have to spend the time developing the relationship. You're still spending that time, but instead of it being 8 people a day, it's 800 or 8,000 or 800,000 in a day who are able to access what it is that you're doing. It's just much more effective. Don't you agree?
100%. And another big thing we did that took a hit to our egos was a misconception that if you did have a prospect or an investor that wanted to talk to you, that you would have to do this tortured 2-hour steak dinner with them and pontificate about the world and interest rates and inflation and how we're smarter than the average bear. And then at the end, you make the ask over dessert and coffee, right?
Right.
What we did was we started to map out the investor experience and the investor journey from the minute they enter into our world to when they eventually invest into an opportunity. And we took out all of the inefficiencies. And so now when we approach somebody with an investment opportunity, we provide drone footage, a videotaped pitch, all of the data in one place, all in one email, so that usually within 10 minutes, if they want to read or watch or listen, they can really understand the investment opportunity and they can make that decision on their own time, and in kind of the most efficient manner possible for the investor.
Well, that's the point, isn't it? It's easier for you, but it's also easier for investors. Nobody wants to, you don't want to sit down for a torturous 2-hour dinner, for heaven's sake. Imagine that.
Yeah.
Right? But neither do investors.
Correct.
They don't want to sit down but they know you're going to pitch. Just get straight to it. And the nicest thing about being able to do it online is you can do it in stealth mode. You can do it all on your phone. You can do it anonymously. You can figure it out without having to go through that brain damage. Yeah. It's the shift in the world. All right, let's just move to another topic, if you don't mind.
Sure.
Now, you are raising money for commercial real estate projects. What you done do. But you also have a capital club. And on your capital club, we've got all kinds of different things. Not even real estate related, right? So I'm not going to say it because I don't want to. Well, I suppose we already dated this by talking about the Ukraine crisis. So but you've got all kinds of various things going on. Just tell me about the capital club. How does pitching somebody else's, or allowing somebody else to pitch their deal on your platform help you raise money for your deals?
Yeah, this will go to the bucket of when you have an idea or a marketing campaign and your peers all say that you're crazy and it doesn't make any sense, you're probably doing something right. And so what started happening was I have a great network of investors, and I'm not a wealth manager, right? So I'm not trying to get all their assets under management. I don't want all their dollars. I want them to engage with me and obviously invest. But, I think the 3 biggest challenges in the high net worth individual and family community right now: access, educational content, and affinity networks, right? And so that's what our marketing is all about, around solving those 3 issues, because I know it's a problem for people. So what started happening was my LPs, would reach out and they would say, hey, I'm looking to learn more about healthcare venture capital, private credit, investing in raw land. I want to invest in the space economy. And I'm like, oh my gosh, okay, that stuff's really cool. Let me go through my mental Rolodex of GPs and sponsors and fund managers that I know that I like, and maybe I can try to make some introductions for you. On the flip side, I started getting my friends who are sponsors and managers and GPs saying, can I raise capital on your platform? I say, well, we don't do that. I'm not a broker dealer. I don't want to be a broker dealer. I've got a good business. And so I just, at some point, just said, screw this. I'm going to make this efficient for everybody. Once a month, I'm going to put on a Zoom where 4 of my friends, people that I know, will pitch. I'll open it up to my network. I'll send it out to LinkedIn and the other things. I'm not going to take any economics, no fees. And hopefully my, peers, my investors, they think that, I'm smart because I'm talking to smart people. And I'm addressing these 3 issues, right? This access, education, and networking in a very safe place, so they can learn about niche strategies, different managers, best ideas, best in class, et cetera. And I think it just, again, goes to that place where, creating a touch point where I'm not asking them for anything other than a little bit of their time. And I think they're getting a lot of value. And frankly, it's not a very heavy lift for us. I mean, I have a lot of people that want to come on. We have pretty good engagement from our investors. And, I don't want it to become like an investment banking broker dealer type setup. It's just not what I'm focused on. And it's really, we're doing it for about a year and it's been really successful.
Very cool. Yeah, it is interesting. And I'm not going to say what's on the site at the moment. Whoever's listening, go to GowerCrowd.com to the podcast page for today. You'll find a link to Brian's website and check it out. It's really cool, actually. It's an interesting.
And I learned a lot myself. I mean, like I said, this investing in the space economy, we had these people on, so cool what they're doing. And so I think it just makes me a better manager to know, what other investment strategies are out there, be it NFTs, blockchain.
Yeah, it's interesting.
Whatever. Yeah, it's cool.
All kinds of stuff out there, isn't there? Yeah. I mean, I'm a one trick pony. Is that the term? I don't know what the bloody expression is. I'm all lost in these things now, but I only know real estate. It's the only thing I know. But I do see these other things kind of wafting across my screen. I know I'm, whatever. Somebody else is brighter than me figuring that.
Yeah, it's
NFTs, for example. Oh my goodness. Yeah. I'm not even going to try and figure that out. Brian, you've also got a newsletter, don't you? And I'm on your list. It's kind of cool. Tell me kind of high level, the highlights of that. How many people are on your newsletter? How often do you send it out? How do you decide what to write about? Kind of give me a high level overview of that.
Yeah, let me look at our contact list. Looks like we've got about 8,000 people on the distribution list right now to get our newsletter. And so we send it.
What kind of info do you send them? And how often? Let's start with that. How often do you write?
Once a month.
Once a month. You have a newsletter once a month.
First of the month. And we're actually rethinking the format. We're always kind of, experimenting here a little bit, but traditionally it's been, we have an article of the month, like one big thought piece about typically kind of macroeconomics or geopolitical, maybe real estate related, maybe not, like a big content piece that we really liked, that we thought was insightful. Maybe some smaller articles that got good engagement from posts on LinkedIn, or that we got good KPIs on from sending them out to various other channels. And then we'll do activities of the month, right? If we hired anybody, if we have a new campaign running, my podcast guests who have been on the show for the last month, if we acquired a new property, we'll have a write-up there. So just kind of a state of play for the company, and then hopefully some links. And then we started doing just what we call, it's a very unrefined term, but just cool stuff. So if somebody on the team is reading a really good book, if somebody on the team has a really great podcast interview that they've heard, typically unreal estate related, right? Just things that are culturally significant that we think would, add a little bit of value to people's lives. We include those in there as well.
And what have you found your subscribers like to hear about particularly? Do you get any sense of that?
Yeah, when we go through like the clicks and the links and the activity, we find that most people just care about that one big article of the month. That's where they typically will click through to the most.
And that's the first link in the email.
Yeah, that's the header on the link. And that's
so. Let me just understand the newsletter, because I want to tell you something. So newsletter. So the way you structure it is you have a page of text inside the email. At the very top is a link to the long form article that you have. Mm-hmm. And you notice that is the one that is being clicked the most.
Mm-hmm.
Yeah, by a large margin, right?
Yeah, typically, yeah.
Yeah, very large margin, right? What are your open and click rates typically?
Oh gosh, we just.
That's all right. I didn't mean to stump the guest. That's all right.
No, it's okay. I think we kind of probably have around a 10% open rate. Something like that.
Okay.
Click rates from the single digits. Yeah.
Okay. So just let's chat ever so briefly once we've finished, because I want to share some insights with you about those numbers. I will tell you this: email marketing is super important and extremely difficult to do well, and a large number of systems will auto click that first link. It's not a good indicator of what the clicks are. Just tell you that clear, just as a FYI. And I'll talk to you about your open rates as well once we wrap up. email marketing is something we have become exceptionally good at.
Yeah. So HubSpot says that the metrics they provide to me are not auto clicks.
So go with that. But I will tell you that if you, just candidly speaking, if your open rate is 10%, that is extremely low. Just FYI, my open rates are push 60%. All right,
Well, yeah, and we've talked about this, but we tranche our investors, right, depending on the engagement and the CRM score they receive. So that's a global open rate. But when we go to our most engaged investors, open rates are typically 90% plus.
And what about the amount of time that people spend on your website? Because that's really the key indicator. Open rates, as you know, are becoming it's becoming a redundant metric anyway, because of the way Apple has changed the way they open emails. So what are you finding with HubSpot? I know you can do it. How are you finding activity on that article, that primary article? Is that how you're determining it's the best one, if not the open rate, the click rate? Are you able to measure that with HubSpot?
We can see how much time people spend on the email and where they're spending the most time in terms of their engagement, but we don't
Can you track how much time they spend on that article once they click through to it?
Not to my knowledge.
Yeah, it's a whole different topic, and we're getting into deep weeds here. Let's leave it. I've got 3 sign-off questions, but
okay.
It is a fundamentally important driver to anybody's business, is the way that email correspondence is conducted, how you measure activity, engagement, and determine who's actually active and who's not. It's really, really difficult. And the open and click rates these days are becoming less and less important.
Yeah, we've started sending text notifications to new investment opportunities. It's an opt-in, right? We don't spam people, but that's gotten a really good response as well. I think people just want to do things on their phone, frankly.
Yeah. So. 3 sign-off questions that I ask everybody. First, what are your key, actually, so let me start with this one. What's been the hardest lesson? You talked about you started in 2010 in commercial real estate. What has been the hardest, and that you made some mistakes first time around. So what was the hardest lesson that you've learned in real estate?
If you want to be successful in this business, right, this fundless sponsor syndication business, you have to understand that the commercial real estate investments have to work, but you won't be able to scale unless you embrace being a small business owner, which means that you need to now start being concerned about HR, accounting, tax, bookkeeping, marketing, sales, social media, things that really don't have anything to do directly with the real estate investments. But you can't just be a deal guy. You will fail eventually.
You got to be a small business entrepreneur. It's really true, isn't it? It's basically a real estate entrepreneur.
Correct.
Second question. Brian, you're a successful guy. What are the key daily habits that you have that keep you successful?
Yeah, I mean, this one's so variable for people. And, I listen to Tim Ferriss and Rich Roll and all these other, big podcast people that ask about daily routines and what people do or don't do every day. And I think some of it's applicable, some of it's not. For me, my morning routine kind of sets the tone for the whole day. So I wake up at 4:10, I have a cup of coffee, I kind of scan, email, the news, I take my dogs out, and then I leave for the gym at 4:40. I get there at 4:53 and I work out until...
Really? I mean, to the minute like this, goodness me.
Yeah. And then I work out until 6 and I get home at 6:13. I wake up my boys at 6:30 and I help them get out the door by 7:20. And we have our time. Like I read the paper, I help them get organized. There's a lot of moving pieces there. And, I'm probably back in work mode at 7:30 or 8 o'clock, depending on if I grabbed a shower before the boys got up. And so that's my morning and that's my day. And if I hit that, and if I get all those pieces right in the morning, I find that I have a really successful day. Where things get rocky is if I've been traveling, if I don't have that routine, if something, messes that up in the morning, it can kind of alter my karma for the rest of the day.
I'm going to throw in an extra question.
Okay.
But I'm going to do the usual one first. So for an investor, an accredited investor who's never invested in private equity real estate before and is interested in doing so, what is the most important thing they should keep in mind before making that first investment?
So I think the number one question that LPs don't ask, limited partners, investors, prospective investors, that you can ask about the deal all day, right? But on some level, you've got to trust the GP and the sponsor that they've done the underwriting correctly, they've done the market comps correctly. I mean, that's the trust in the relationship. So you can beat up the sponsor about the deals all you want. They're going to give you smart answers if they know what they're doing. The questions that LPs never ask that they should: what does your investor relations software look like? What is your communication protocol? What are my expectations in terms of transparency on a daily, monthly, weekly, quarterly, annual basis? What does your reporting look like? Can you give me an example? If I call somebody, how soon will somebody respond to that call? All of these things that have to do with the investor journey, investor experience, that, the deal is going to be what the deal is. We all hope they're successful. But what I tell people is, if the deal's going well, if I'm giving you a text notification that money has hit your ACH account the 15th of the month, every month for 3 to 4 years, we're probably not going to have a lot to talk about. You're not going to call me other than probably say, hey, can you send me another deal? Where you will talk to me is when the deal goes sideways, when there's a problem and an issue. And then what you want to know is, what am I going to do as a GP and a sponsor to fix the problem and to help make sure that I communicate with you directly about how we're doing the work in order to right size the issue. Those are things that most LPs never talk about. And I think those are the questions that you should be asking your GP sponsor relationships.
Extremely interesting insight, Brian. Thank you. All right. So here's my last question. Bonus for 10. What's your favorite book? I've been reading the same books over and over again. I need something else other than my books. Apart from my books, what's your favorite book?
This is like fiction, or?
I don't care. Yeah, what's a good read?
I mean, I'm a huge Hemingway guy, so The Sun Also Rises. I think, I could read that book once a year, every year. It's something, again, to go back to my father, one of the best gifts he gave to me was a love for Hemingway and how succinct he is. And everything going on in Europe right now, it's actually fairly timely. So,
right, The Sun Also Rises. I don't have to get that. Thank you so much.
Enjoy it. It's a good one. Yeah.
Brian Adams, Excelsior Capital, an enormous pleasure. It's been far too long. I'm so sorry it took so long to get together with you. Really fabulous. Thanks so much for joining me on the podcast.
Appreciate the opportunity. Thank you. I'm a huge fan of what you're doing, so keep it up.
Thanks, Brian. That was Brian Adams, founder of Excelsior Capital. Find out more about Brian on the podcast page for today's episode there at GowerCrowd.com. And if you've not done so, click the subscribe button at the top of the page. You will get access to our weekly newsletter that goes out every Wednesday with information on everything that's going on in the real estate syndication, aka crowdfunding world. It is utterly comprehensive and the most detailed of anything that you will find on the industry anywhere on the net. It's all there at GowerCrowd.com, and the price is right. It is totally free. All right, Brian, thank you so much for joining me today. Brian Adams of Excelsior Capital. Really appreciate the time you spent. And thank you also, of course, dear listener, for tuning in. I'm glad that you have stuck around all the way to the end. I hope you found what Brian had to say of interest. I certainly did. And I look forward to sharing with you our guest next week. That's all that we have for today. Be well, stay safe, and for now, this is Adam Gower signing off.